Okay, so in today's video breakdown, no fundamentals today on Monday to really discuss or digest. We're really just going to be talking about the market environment that unfolded today as we saw stocks and forex open. Um, we're going to hopefully get you guys to understand why we are seeing a slight market retracement in risk assets like crypto and stocks. That's my goal here today is to educate you guys on why we're seeing that market pullback so that way you don't hop on Twitter or on YouTube and watch these individuals that are constantly telling you that the market's going to go up. We here at CYPRX have been tracking these price fluctuations for the longest time. If you've been a part of this community, you can see how accurate our fundamental analysis is and why it's so imperative that you guys pay attention to central bank positioning, geopolitical risks, all of these data points that come out every single day, and how to really start to implement this into your trading and your investing career. For example, okay, um, overnight during Asia session, rolling into UK and then now rolling into New York, if you're paying attention, the sentiment has slightly shifted hands, right? We're seeing a slight risk off market environment. GBP's down today, dollars up stronger, gold's up stronger, risk assets like crypto and stocks are slightly down on the day. And so I'm not saying that now is a perfect opportunity to take profit because we don't want to get too ahead of ourselves. But if you were getting into positions, for example, like those Bitcoin call outs at 58,000, we saw surge all the way up to almost 70,000. XLR at 55 cents surged all the way up today to 90 cents. Is it an opportune moment to start to take some profits off the table, even if it's just some slight profit taking? For example, I think I put like, I don't know, $10,000 or $11,000 or something like that into XLR. That's well worth more than that now. Could I take $2,000 or $3,000 off the table, considering the risk off market sentiment today, and then roll that into stable coins? Absolutely. Am I personally? No, I'm not. But as a trader, as an investor, as somebody that wants to grow and scale their bags, could you? Yes, absolutely. Right. And you can do that through understanding these market dynamics and when it's time to do so. Okay. So just to show you guys, in previous reports, I'm just going to use yesterday's as an immediate example, but we've been excuse me, we've been touching on this for the longest time. What factors to be paying attention to? And so just to show you guys today, those factors unfolding in real time, you can go back to multiple previous reports tracked way back from before just yesterday. I'm just showing this because it was the most immediate report to click on. But highlighted in the majority of previous reports, we have consistently been discussing some of the risk factors that could still weigh on the sentiment of the digital asset landscape, particularly in our focus today, which is a risk asset class. And two of those factors that I want to touch on today are the geopolitical tensions and escalations that still remain on the table, which we told you guys to be paying attention to, and then the US economic data front, where any data or any sentiment that contradicts the future positioning of central bank policy via the Federal Reserve cutting interest rates further is going to start to weigh on risk sentiment because the market is heavily pricing in a global interest rate cut environment or a lower interest rate environment, and the Fed plays a big position in that narrative, right? So if the Fed starts to deliver a narrative where they are signaling to the markets that they're going to remain in a higher interest rate for longer environment, that's going to make bond yields jump. That's going to make the dollar strengthen against other major G10 currencies like the euro, the Great British pound, the Japanese yen, the Chinese yuan, so on and so forth. And we're going to see that shift of liquidity come out of risk assets and into dollars, right? And we're seeing that unfold now today, right? So we're going to cover that. I want to touch on again why we're seeing $64 billion of outflow out of the digital asset landscape, seeing a market pullback, dollars almost touching the 104, which we mentioned myself and Angel and other individuals tracking in the GBP USD chat that was probably the most logical scenario to play out, which we're seeing it unfold in real time. And GBP USD still under sell pressure, which we also told you guys to be paying attention to. All right. So I'm just trying to cover this to touch base on why we've continued to tell you guys to pay attention to these risks that still remain in the market, not to get too overly optimistic, as we saw the crypto fear and greed index over the weekend hit a high that it hasn't reached since July of this year, when we were operating at 2.4 to 2.3 trillion dollars. And now the same sentiment is still unfolding, where constantly, month after month, every single time risk assets, in this case crypto, come into a premium, it's so crazy how these algorithms align with the fundamentals. At the same exact time, these fundamentals and the price analytics, the charts come up into a premium. Don't you guys find it odd that that's when all the geopolitical tensions start to escalate and all the Fed speakers start to talk on those days that price is at a premium? It's all by design, right? It's literally all by design. So that way these more highly educated hedge funds, asset managers, private family offices with so much more money than you and I that actually move these markets can have a reason to take profit and so on and so forth and actually move these markets to certain price levels. But on the retail side of things, because we don't have as much information and, you know, tools as they do to our advantage, we have to be able to pay attention to these things. All right. And so, again, we're just trying to track these things for you guys so that way you can stay ahead of the curve. So let's just digest today's breakdown. Let's get you guys to understand why the market has pulled back $64 billion in crypto, why we're not seeing a continued surge in risk on market sentiment, and what changed over the past, let's just say 48 hours. Because Friday, Saturday, we saw an extremely bullish, optimistic market mood, and that sentiment has slightly dwindled today. Nothing to be too fearful of yet. Remember, anything bullish above $2 trillion, even if we did see a market pullback, I'm still highly optimistic. I would only start to change my sentiment and really start to take profit if we broke $2 trillion. Why? Because we were dollar cost averaging in back at the beginning of August and September when the market was around 1.6 to 1.7 trillion. So even if we took profit at $2 trillion, if we did see a market pullback there, we'd still see some profits, right? I just personally don't want to get too ahead of myself and take profits too early to reallocate capital. So that's just my strategy, right? So anyways, today, the total cryptocurrency market cap, let's zoom in so you guys can see this. All right, today the total cryptocurrency market cap saw a significant pullback, losing over $64 billion in value. We touched roughly about 2.34 trillion, and we are currently hovering at about 2.2 some odd trillion dollars. This reinforces the caution that we've emphasized in previous analysis, where we noted the need for a tempered optimism given the lingering downside risks that still remain in the market. Today's shift to risk-off sentiment was driven by several key factors, including stronger US dollar, rising bond yields, which we'll break down in detail in this report. You guys have it in the Discord chat if you want to open it and read along, and hawkish signals from Federal Reserve officials, along with ongoing geopolitical tensions. So literally all things that we've been telling you guys to fixate your attention on. The US dollar index today rose by 0.18% as Treasury yields climbed, enhancing the dollar's appeal through higher interest rate differentials. Keep in mind, across the globe, right, the ECB cut rates, the Bank of England is expected to cut rates further on this side of the world. The Bank of Canada is also expected to cut rates more aggressively than the Federal Reserve. And so we're seeing an uptick in demand for the dollar as market participants are starting to price in on a global scale that they're going to get a higher interest rate on dollars instead of, other domestic currencies such as the Canadian dollar, the Great British pound, or the euro, so on and so forth, right? Um, so also today, hawkish comments from Dallas Fed President Logan also supported the dollar as she indicated a preference for a gradual reduction in interest rates. This is a hawkish vocabulary terminology that you guys want to pay attention to. What would be the opposite of gradual interest rate reductions, right? That would be heavy easing or a more rapid interest rate reduction, which is what the market was pricing in towards the end of September, right? As we rolled into October, okay? The market was pricing in, if you guys remember, aggressive 50 basis point cuts from the Fed. That sentiment has completely shifted hands, where right now the market is expecting a 0% chance of a 50 basis point cut from the Fed, right? She also mentioned while still aiming to manage economic risks effectively, Logan's remarks suggested that while rate cuts might be on the horizon, the Fed is likely to maintain a higher for longer approach to monetary policy. That is also a hawkish comment right there, or hawkish vocabulary. Okay, keep that in mind moving forward in your trading and your investing career. That's what we want to be paying attention to. So here's a little bit of an article that I utilized to gather that information. You guys can read through that. Right now, market expectations currently indicate a 92% probability of a 25 basis point rate cut in November on the 6th to the 7th Federal Open Market Committee meeting. So that's why I'm not too pessimistic about this current market pullback, is because the market's most likely still going to price in rate cuts moving forward. If this percentage chance decreases this week or heading into the last week of October, right, then we need to start to be a little bit more concerned. Okay. So, for example, if towards the end of this week, this number drops to like 80%, 70% because of extremely upbeat or supportive fundamental data from the US, then we can start to really consider possibly shifting profits, because we know that a prolonged interest rate environment, i.e., no future rate cut projections from the Fed, will be one of those factors that weighs on risk sentiment. But for now, the market is still pricing in a high probability of a 25 basis point cut. So I'm still going to just consider this most recent dip in price a pullback. Okay. Um, so right now, no likelihood of a 50 basis point cut. However, rising bond yields have also put pressure on equity markets, with the 10-year Treasury yield climbing to its highest level in 2.5 months. The increase in yields reflect expectations of prolonged periods of elevated rates, which tends to weigh on stocks and crypto by increasing borrowing costs and making risk-free assets like the dollar more attractive. All right, so here is a screenshot of the current bond yield environment. You guys can click through this and you can read it, but you can see that as of October 21st, we've seen a new high reached in the 10-year and the 2-year bond yields. So let me just break this down for you guys so that way you understand this and why it creates not necessarily a risk-off environment, but right now a temporary risk-off environment. Okay. So, what are bond yields and how to understand their effect on risk assets? I know that this seems like a lot of information to track, which is why I stress the importance of constantly reading this information, watching the Zoom calls. If you miss a Zoom call, stay up to date on them and rewatch them. So that way you guys learn this stuff a lot faster than it took me. I had no mentor, no individual to teach me this stuff. It was just me constantly applying fundamentals to live market price action and losing a lot of fucking money, right? So hopefully I'm mitigating that for you guys and showing you all that this is the type of stuff that sways these markets in certain directions. So, bond yields rising. Let's talk about why this weighed on risk sentiment. And this plays a large factor in the interest rate cut environment. So keep in mind, Fed's comments today weighed on the narrative that the Fed is going to aggressively cut rates, right? She delivered hawkish comments, or at least what the market perceived as hawkish comments, which tends to benefit the dollar and push back on the rate cut narrative. Bond yields refer to the interest rate or return that investors receive for holding a bond, such as a U.S. Treasury bond. The yield on a bond is inversely related to its price. When a bond prices fall, yields rise, and vice versa. Bond yields are often considered a benchmark for the cost of borrowing and are influenced by various factors, including expectations for inflation, economic growth, and central bank policies. When bond yields rise, it indicates that investors are demanding higher returns to compensate for perceived risk, such as inflation or economic uncertainty. For example, if the 10-year Treasury yield increases, it suggests that borrowing costs are going up, not just for the government, but also for businesses and consumers. This increase in yield can affect risk assets like stocks and cryptocurrencies in multiple different ways. So I broke those down for you guys. First, the cost of capital increases. Higher bond yields make borrowing more expensive for companies, which can reduce corporate profits. This can lead to lower stock prices as investors reassess the future earning potential of companies and adjust valuations downward. Attractive alternative to risks. As bond yields rise, fixed income investments like bonds become more attractive compared to riskier assets like stocks and crypto, which do not offer guaranteed returns because they're more speculative. When investors can get a higher yield from bonds, they may prefer to move capital out of risk assets into bonds, leading to sell pressure in stocks and cryptocurrencies. So, as the Fed commentary today delivered a more hawkish comment, pushing back on rate cuts and delivering an environment where the market's starting to expect a higher for longer interest rate environment, we saw that shift in an allocation of capital. At the same exact time that that happened, the hawkish commentary from Fed speakers and stronger dollar happened. Where was crypto trading at? At a premium. So all these investors that were moving the market up, buying from August lows, September lows that are now in profit and prices at a premium, market conditions are shifting, and what are they doing? They're just reallocating that capital. They're taking profit. They're moving that profit into, you guys see what I'm saying? So you see how that shift happens. All right. So impact on discounted rates as well. That's number three. The valuation of stocks, particularly growth stocks, is sensitive to interest rates because future cash flows are discounted back to their present value using a discounted rate. When bond yields rise, the discount rate increases, which lowers the present value of future earnings, thereby reducing stock prices. This is especially true for tech and growth sectors, which rely heavily on future growth. And we are set to get some of those numbers coming out this week, and I will write about that for you guys in future reports, probably tomorrow's report. Then we also have the strengthening US dollar. So higher bond yields can attract foreign investors seeking better returns, keeping in mind as well foreign investors mentioning that. What are we seeing across the globe? For example, in the ECB, we're seeing a lower interest rate cut environment. We're also seeing prospects of future rate cuts from the Bank of England. We're also seeing no future rate hike projections from the Bank of Japan. On this side of the world, we're also seeing the Bank of Canada future rate cut projections. So right now, the dollar is the most attractive domestic currency compared to other domestic currencies, considering the economic situations across the globe from other major jurisdictions, right? So I broke this down, gave you guys an example scenario. Just read through this. I don't want to continue to bore you guys to death, but hopefully you kind of understand why rising bond yields now negatively affect, in the short term, risk assets like stocks and crypto. Okay. And why we're seeing that shift in allocation and capital. Um, so another factor today that weighed on risk sentiment, I couldn't find any immediate escalations and tensions that took place. Michael, like I said in the chat, has been covering that astronomically, giving you guys updates on things that I even personally can't find on the Middle East tensions. But one little tiny snippet of an article that I did read here, it says further geopolitical risks contributed to the negative market mood in the Middle East tensions remain high as Israel continues its military operations in Gaza and Lebanon, engaging Hezbollah forces and conducting airstrikes in Beirut's southern suburbs. The deployment of additional Israeli troops in southern Lebanon and anticipation of a potential response to the October 1st missile attack from Iran have kept investors on edge. So we're still seeing the geopolitics weigh on risk sentiment and refrain investors with much more money than you and I that actually move these markets from taking aggressive bullish bets. Okay. So these are the three factors that, in my personal opinion, doing the data analysis today and reading all these digests, because, gathering all this information, I read at least 5 to 6 fundamentals this morning for you guys to digest what's weighing on risk sentiment. These were the primary factors today that I found that were weighing on the prices of digital assets, strengthening the dollar and weighing on assets like the pound or stocks. Okay. So moving forward, if we want to see a further, turnaround in risk sentiment, what are some things that we need to see? We need to see possible ceasefire talks. We need to see de-escalations of geopolitical tensions or no further breaking headlines on the geopolitical forefront. We need to see data or comments from Fed speakers supporting future rate cuts, keeping this 92% chance, wherever it's at, keeping this 92% chance of a future probability of a 25 basis point cut on the table, or bringing back data supporting a 50 basis point cut, right? Giving the market forward optimism that we are set to continue to head into a low interest rate environment. Okay. So these are the things that we're going to continue to pay attention to. Let's just take a quick look at the total cryptocurrency market cap. Is anybody confused right now on that breakdown and what's weighing on risk sentiment currently? Why, 2 days ago we were seeing risk on sentiment, how that shifted as the markets open, rolling into Sunday, Monday. Is anybody confused on that forefront? Hopefully I did a good job breaking that down for you guys.
Oh, I'm getting it. It's pretty good.
All
Thanks.
right, cool. I'm never on the opposite side of my lessons, so I try to, visualize how you guys are comprehending and digesting the info. So hopefully I make it easily digestible for you guys.